Hello and welcome to this special coverage of Aditya Birla Sunlife Mutual Fund presents Voyage 2019 powered by ET Now. With almost 2,000 people in attendance, the flagship event, now in its sixth year, is aimed at helping investors and distributors understand the market movements and global economic trends. On this episode, watch as Timothy Moore and Sriram Vasudevan share their expertise at empowering distribution partners, institutional investors and individuals to make more informed investment decisions across changing tides of market conditions. Let's listen in.
It's a wonderful pleasure to be here in front of all of you, and I hope I can add some perspective on kind of the larger global picture and our broader regional equity views to the very detailed analysis that you've already had on India, both from the fixed income as well as the equity side. So without further ado, let's go straight into our presentation here and our thoughts for the global asset backdrop and more specifically the outlook for Asian equities. And the one-line summary is that we remain positive on Asian equities, in particular on China and India. So there are three key reasons why we think the environment right now is still conducive for further equity gains. So point number one is that financial conditions and monetary policy have eased quite significantly. Point number two, which is somewhat more contentious, but there's increasing evidence of this in the recent data, is that growth is picking up globally. In fact, our view has been that growth is likely to be accelerating and picking up in the global economy, at least in the second quarter, and the recent data coming out of both the United States and China is certainly supporting that contention. The third point, of course, is at the micro level, we think that the persistent trend of downward adjustments in earnings that has been the case for at least the past year is beginning to inflect. It's beginning to improve. And so at the micro level, we're seeing the improvement in the global economy filter down to a stabilization of earnings growth. And of course, that's very good for equity markets. So that's the good news and the three key points why we remain constructive on markets. Fortunately, we think that earnings growth will be reasonably good from here. So that will give us still some trended upside in equity markets, and more specifically within the Asia-Pacific region, we favor the equity markets of China and India. Finally, thematically, we think that a good place to be within the equity markets, it would be the two themes of either growth or yield. Growth, of course, because everyone wants stocks that are growing well, as long as you're not overpaying for them, and yield, of course, against the backdrop, at least outside of India, of a quite low fixed income environment. So the attraction of, say, a 4 or 5% dividend yield, which you can get on many stocks in the Asia-Pacific region, is, of course, enhanced when you are seeing your alternative of interest rates being lower for longer. Well, as you can see from this chart, if you look carefully, there was a very strong tightening of financial conditions late last year, which was, in our view, one of the prime reasons why asset markets were under such pressure. Fortunately, this year that's been unwound to a very significant degree, and we think this is the prime reason for why we've seen a lift in equity markets across the globe, including here in India. So this is our expectation for earnings growth after a long period of successive downgrades to earnings growth and a slowing. We expect on a quarterly basis for earnings growth to pick up into the end of this year, which obviously is good news and something the market has anticipated. We think that underlying positioning by investors is still fairly conservative. In other words, investors got quite scared at the end of last year. We had a very bad fourth quarter, as I'm sure everyone in this room is aware of, and that caused many investors globally to be quite conservative, to pull in their metaphorical horns. And so what we see from this chart is that the positioning of nearly $2 trillion worth of global mutual funds in the Asia-Pacific region is about 600 basis points below their benchmark level. The punchline, particularly for those of you who may not be able to see it as clearly in the back of the room, is that we're overweight equities. We continue to like them, although we think overall returns from here will probably be more single-digit positive as opposed to sort of 15, 20%. We think that having some cash on hand is a good idea as a hedge against some volatility, and we're underweight, in particular, government bonds, which we think suggests that they're not as good value as the equities are. So that's basically our broad global asset allocation mix. Turning to a couple of wild cards, which I haven't yet discussed, and which are obviously very relevant for India. Number one, of course, is oil. We think basically we're at the upper end of a trading range for oil. So I know there's lots of concern in the market that with oil at the low 70s on Brent, that if it spiked up further to say 80 or so, that would be quite negative for India, given India's reliance on imported oil. Number two, of course, is the dollar. And here, our view is that if you looked at the dollar alone, we would expect some moderate softening in the dollar. And so when we look at the dollar against the developed market currencies, the euro's not looking terribly great right now, and neither is the yen. So it kind of suggests maybe some stability until we get further into the year, maybe see a little bit better signs of fundamental strength in either Europe or Japan. So overall, we think it's probably not going to be as destabilizing a factor as it was last year. The third wild card, of course, is China and U.S. Trade relations. This is an index of so-called trade uncertainty. We are certainly more optimistic on the trade outlook than we were, say, 6 months ago. So overall, there are a number of clear reasons to remain constructive on China, and so that is something which we want to emphasize. Let me close my prepared comments with just a very quick overview of our view in India. We just want to share with you our perspective, maybe from a so-called foreigner's perspective, of why we think the investment case for India remains constructive. One, we think that on balance, the overall fundamentals will be improving. So we think that the cyclical slowdown in India is showing some signs of plateauing. We actually expect things to begin to improve as we go into next year, number one. Number two, inflation, as mentioned earlier by my colleague, is at the lower end of the RBI's targeted range. And of course, that means that the RBI can continue to be accommodative, and we expect another 25 basis point cut in the third quarter. India would be the number one growing market in terms of earnings of all the 11 markets that we cover. And then, of course, there's the near-term issue of the elections. Of course, we're not taking any view on the elections, but we do note is if you look at the last 6 election cycles, which is what we show on the left side chart, that the market tends to perform well into the elections and still about 1 month afterwards. So let me stop there, and thank you very, very much for your time and attention. Thank you so much, everyone.
Thank you all for coming today for my talk on energy. And the best part about coming to this event is I came in saying I'm going to talk about the new world order, 2020s and beyond. And somebody here told me the next 24 hours and beyond, given where oil is, and we want to have a very clear and pointed view of where we are and where we are headed. And I'll try to give you that, right? So let's talk about 2020s and beyond. There are basically 3 factors, right? There are 3 factors that matter for 2020s and beyond. First and foremost, LNG. Yes, LNG, people think of it as gas supply, but essentially when you do analysis, a gas supply of that quantum also comes with a huge associated supply of LPG, ethane, condensate, which effectively are shadow supply for oil. And even from the demand destruction front, every unit of LPG displaces 0.4 units of fuel oil and 0.6 units of coal and others, which again, right, where the mining is very diesel intensive. So there's indirect demand destruction plus shadow supply coming from LNG, and we have a massive surge in LNG supply. That's the first factor. Secondly, and this is possibly geopolitically the most important call, our own call now for OPEC is it is going to get very fragmented, potentially as early as end of this year or next year, depends literally as to when you have regime change in Venezuela. And finally, a lot of modeling work we've done on EVs, the future of mobility, shows us there's a secular decline in gasoline demand growth that you can't get away from. So you have a demand picture that's staring you in the face, and I think that's actually well understood by many of the GCC countries as well, oil producers, members of OPEC cartel, that you are facing a big decline in gasoline demand coming online. This is the dual hit to balances from LNG, a very, very important point. Look, we have about 133 million tons per annum of LNG coming by 2025, and just the indirect impact of it, right, in terms of squeezing out fuel oil, in terms of squeezing out coal and therefore diesel demand for coal mining, and in terms of associated, the LPG that comes with it, the ethane condensate that comes from it, and the naphtha you kick out of the petchem stack, that's 2 million barrels per day. So it's really big. This is something that anyone looking at oil balances has to contend with. There will be a big surge in LNG supply from now through 2025. And in terms of power generation, there's plenty of demand in China. There's no issue with fuel oil substitution. So we don't think that there's any major demand hurdle that creates any problem in terms of absorbing this incremental supply. Now for the most fun part, neutralization of OPEC. Why was OPEC even able to stay alive as a cartel over the last decade? You know, some interruptions, but broadly stay alive as a cartel. The reason is Saudi and GCC didn't need to make as much relative concessions because Venezuelan supply was declining. However, it's a very different picture if there's regime change in Venezuela, which is quite likely, you know, looking at the actions of US governments and most European countries here. And finally, the EV megatrend. This is for real, the EV penetration. And the main point I want to make here is companies are actually putting money where their mouth is. Very importantly, high end is where margins are made in the auto industry, and that subsidizes the lower end over time, right? So you will see increasing penetration, but at the very high end, if the battle is won, then the battle is already won in terms of EV penetration. And that's why we are confident with our overall projections. So the battery costs are coming down sharply, and even with subsidy removal, we think by 2020, EVs should be cheaper than they are now. And at the same time, you know, you have more regulation on internal combustion engines that gets more expensive. You are headed to significant EV penetration. The main issue is the charging outlets, and people are still solving it. This is the big unknown for the EV assumption, right? Basically, the world has to go to a smartphone model from a retail filling station model, right? Because to fill an EV takes significant time, even with high charge density. So you need huge charging infrastructure for people to be able to charge it. Again, a lot of our EV penetration numbers are driven by China, EU, and US. China is already making the moves. So those are the big drivers. Those are the things we are watching. Thank you.
It's time for a short break, but when we return, we get you more insights from the market moguls who will engage in a power-packed panel as they analyze how the financial markets have performed in the last 1 year and how is the market expected to behave in the coming year. We'll be right back. Welcome back to Voyage 2019, presented by Aditya Birla Sunlife Mutual Fund and powered by ET Now. Let's take a look at what the market experts have to say about factors that have propelled the growth of the Indian economy and areas that require immediate attention. Here are the highlights.
So, Rhythm, let me start with you. I don't know where I should start. Elections, earnings, capex, which one to take first? At this point, at this juncture, really, what's your sense?
So let me just keep the valuation thing out of the way. The market is trading at 3.2 times book, which is right in the middle of its historical range of 2 to 4. There's nothing in valuations either to celebrate or to be worried about. But remember, earnings are very depressed. We're coming out of an 8-year down cycle in earnings. So our view is that earnings are turning. India is coming out of a long drawn down cycle in earnings. And our view is that corporate margins will be entering into a 5-year upcycle. So we're going to get very strong earnings, which will drive this market higher. And the second thing is what all these people are doing with their investors, which is investors in India have found new love for equities. We've come out of the period where people did not like equities as an asset class. This is a structural story. It has nothing to do with demonetization. It's a secular shift in investor attitude towards equities, and this will sustain for a long time. It's not going to be over in 1, 2, 3, 5 years. It'll probably go on for another 15, 20 years before it's done and dusted.
Okay, fantastic. So, Bharat, let me bring you in here. In terms of near-term risks, for example, lately we've been talking about crude prices and really the context in the overall global scenario as well. Do you feel there is anything to worry about there?
Well, there'll always be something to worry about. But I guess, we really have to look at the structural drivers of growth. And I think there we are extremely well placed. I mean, we have fantastic demographics, 60% of the population less than 30 years old, and they will continue to grow, they'll continue to consume. You have a major trend in the form of urbanization. And then again, look at the infrastructure that we have. I mean, there is so much ability to absorb capital. So I think, these are great structural drivers.
Mahesh, just to bring you in here as well. I mean, while it's all systems go and everyone's very confident of the story going forward, investors, or particularly the retail investors, are still questioning the rate of returns. And I know all of you have at some point or the other talked about a steady rate of return over a longer period of time. But how do you convince the investor that has perhaps seen the market in the last round of volatility and perhaps had their fingers burned, that this is just the beginning?
So I think it's important to really look back and what the historical long-term returns have been across asset classes, whether it is equity, debt, real estate. So there's a good long-term data which we have. Equities have given around, on average, around 13%. This is for the index, CAGR, in the last 10 years, 15 years, 20-year time frame. And it's been in line slightly better than the long-term nominal GDP growth rate, a tad higher than that. And that's what I think one should expect. I mean, it might probably be lower in the next decade or so because as our call is that inflation would be lower than what it was historically. So even if real GDP growth is around 7% or so, your nominal GDP will be slightly lower. So you could be a tad lower than that. And funds have given outperformance, like in the last 10 years, the 15-year data, as I showed in the multi-cap category. It's been around 3 to 4% outperformance vis-a-vis the benchmark.
Manish, I'm going to bring you in here as well and talk about, in terms of what we were just discussing with regards to rates, inflation, the outlook going forward. Again, if one interprets that into the return scenario, how are we looking at things? Do you perhaps see a softening going forward? Do you see that, boosting sentiment or driving consumption, driving growth and having its own part?
Inflation broadly is underwhelming. Pretty much everyone in India, kind of believe that we tend to inflate at about 7-8%. It's been more like 4.5% for the last 3-4 years. It has large implications on all sorts of assets. And what Rhythm mentioned, that one must, at least from a nominal standpoint, should look at lower returns because inflation is going to trend about 3 to 4% lower than what historically it's been. India has typically been a very, very capital-starved and a capacity-starved economy. That's typically a case when a country moves from $1,000 to $2,000. It's kind of discovered by many investors, promoters, entrepreneurs, and so on and so forth. For the size of ours, we by now have built a reasonable amount of capital stock ready to be deployed. This, we wouldn't have imagined, so many people coming in from all sorts of places in this country to deploy capital. So, which essentially is about, tells you that it's an evolution in the mindset of an investor that he's ready to kind of deploy risk capital. Which essentially, this also means that your returns would be somewhat depressed because there's a lot more capital today to be deployed, both by promoters and investors.
Okay, so where's the money going? That's the big question. I know, Rhythm, you've talked a lot about cyclicals and perhaps the move there. Is that something that you're still closely looking at? Talk us through the thought behind it, why you think that's going to be the next big theme.
I think it all depends on time frame. Sure. So if your time frame is longer term, then I think the two best sectors will be financials and consumers. The transition in per capita income. So we've gone from 1,000 to 2,000. Now we are going from 2,000 to 4,000. And when we go from 2,000 to 4,000, there'll be a perceptible shift in how this country consumes. $2,000 makes us a very poor country. We are a poor country. The people here in this room are an exception. This is not the typical Indian. The typical Indian is surviving with great difficulty and is largely spending his income or her income on buying food. But when that average income goes beyond $2,000, suddenly you get spare income to consume other things. So I don't think the market is oblivious to this, which is why I think there's a bid on consumer stocks, because the market realizes that a lot of segments in consumption will grow a whole lot faster than the economy. Banks and the consumption stocks are the place to be. Thematically, I would avoid the exporters because I think they'll underperform. But, the market has its own cycles and things go up and down. So at various points in time, they become more attractively valued. And with regards to cyclicals, that's largely to do with where we are in the economy. If the economy is going to pick up, then I think industrials will do well.
Where do you see action picking up in the markets? Would it be in some of the beaten down sectors? Where do you see new leadership? Are you sticking to, as Rhythm mentioned, themes driven by the consumption story, for example, by the spending story?
No, so I agree with Rhythm that, we are grossly underbuilt and underhoused economy, and we need to focus on hyper-local businesses, instead of goods. And so, at this stage of economy, instead of focusing on tertiary economy, if we could ensure that per capita housing kind of improves, it improves all sorts of local area businesses, be it furniture, paint, and everything else. It would employ millions and millions of people that we need to kind of employ. My sense is that over the next few years, we're going to do what China has done in front of us, and basically build big cities, and they shall come and inhabit them, and eventually we'll have a big boom in productivity.
Bharat, what are the themes you are looking at?
No, I'll just take off from where I think Manish left. I think, obviously consumption is a great theme in India. I mean, given the demographics and given the urbanization. But within consumption, I think there's going to be a great opportunity in terms of the new age services that open up and that will come to market. I mean, you look at things like education, hospitality, hotels, or for that matter, even things like insurance or aviation. I think, the consumer is now getting into most of these services. And these are very, very underpenetrated markets. So I think, one, there's going to be a huge opportunity out there over the next 2-3 years because we'll see a lot of private equity money has already gone into these areas. And they will now come to the public markets. So I think there'll be a very meaningful opportunity in, in internet, in retail, in insurance, aviation, all the themes that I mentioned. And I think this is one place where a lot of money can be made. Also, over the next 2 years, it's difficult to time, but I think we will see a recovery in the investment cycle. So I think these are new areas where perhaps valuations are not going to be headwinds and where there's going to be reasonable money made.
But Mahesh, closing comments then from you.
I would say that, as we discussed earlier, I think India, while the global growth is slowing down, we don't have the tailwind. I think the foundation is there for India. For somebody looking to invest in equity with a longer term view, I think more important is not the absolute return, right? It's the longevity of that, right? If you're able to generate a return of even around 11-12%, but over a decade or so, I think that's what creates wealth. And I think India has that foundation and potential to do that over the longer term. And that's why you should be in this market, stay invested, irrespective of the elections, whatever happens, whether interest rate go up or down. I think that's the one clear message I think I would like to say. And without really focusing on the near-term volatility, what's going to happen on the global front, I think investors need to look beyond that and make the right allocation. Right allocation, both debt and equity. I think if we do that, I think investors should be happy.
Okay, a big round of applause, please. We've got a fabulous panel here today. Thank you so much, gentlemen. Thank you.
That's all on this episode. Thank you for joining us on Aditya Birla Sunlife Mutual Fund presents Voyage 2019, powered by ET Now. But we'll be back next week with the last set of thought leaders expressing their views about the Indian economy's march towards attaining the $5 trillion mark. Thank you so much for watching.